Hi everyone, welcome back to this week's lesson. So my name is Zixing and today we'll be looking at Bitcoin and Ethereum. So last week you guys went through a lesson about blockchain and its properties. So let's start off with our first video with a technical overview on Bitcoin. So Bitcoin is a digital currency created in 2009 by Satoshi Nakamoto. It's the world's largest cryptocurrency by market capitalization. It's very popular, even though it's not legal tender in most parts of the world. It was built with the goal of being able to secure digital cash without using a real name, without central authority, and to become the first to solve the double spending problem through a proof of work mechanism. Let me explain all these terms in greater detail. So how does Bitcoin work? Unlike fiat currency, Bitcoin is created, distributed, traded, and stored using a decentralized ledger system, which is known as a blockchain. So in the Bitcoin system, it's a collection of computers, also known as nodes or miners, that will run Bitcoin's code and store its blockchain. So imagine a blockchain as a collection of blocks where each block is a collection of transactions. So all the computers running the blockchain would have the same list of blocks and transactions with a very transparent view of new Bitcoin transactions where no one can cheat the system. So all transactions are verified by a massive amount of computing power. Any given blockchain consists of a single chain of discrete blocks on information arranged chronologically. So this information can be any string of ones and zeros, and any type of contract between two parties can be established on a blockchain if both parties agree to it, where no third party is needed. So this allows peer-to-peer financial products like loans or decentralized saving accounts without any banks involved. So this blockchain would stop people from spending coins that they don't own, making copies, or undoing transactions. The Bitcoin blockchain contains every block since inception, where the first block is known as the Genesis block. So Bitcoin uses a proof of work consensus mechanism, where miners compete to solve a computationally intensive puzzle. The winning miner is rewarded with a set number of Bitcoin called the block reward. And one miner wins the block reward roughly every 10 minutes, where more processing power increases a miner's chances of winning. And miners can't accelerate or alter Bitcoin's supply schedule. I'll be expanding on this point later. So you might be wondering what's inside each block of a blockchain. So a block contains the following. We have the header. So that's the version number, which describes the structure of the data inside the block, the hash of the previous block header, which is an identification number for the previous block, the hash of the root of the Merkle tree of all transactions in the current block, which is all the transactions inside the block hashed together to form a single line of text. So all of the fields are unique, but you can think of this as the most significant part of the block header. And then the timestamp, which is just the current time, the difficulty target of the current block, which means like how difficult the target hash will be to find. So it's just a value that miners will work with to try and add the candidate block to the blockchain. And lastly, the nonce, which is the extra number that you hash the block header with. It's just a dummy field that miners use to help them get a block hash below the target value. So this is how it kind of looks like. And then under the data, we also have the following fields over here. So the version number, the flag, transaction inputs and outputs, witnesses, and the log time. So why do Bitcoins have value? Today, a Bitcoin costs around 53,000 as of now. And so successful currencies have 6 key attributes: scarcity, divisibility, utility, transportability, durability, and counterfeitability. So Bitcoin has value because it holds up very well when it comes to these 6 characteristics. Although its biggest issue is its status as a unit of exchange, as most businesses have yet to accept it as a form of payment. So firstly, scarcity. When Bitcoin was launched in 2009, its developer determined that the supply of tokens would be kept at 21 million. So generally, scarcity can drive value higher, which you can see with like precious metals like gold. And next, divisibility. So Bitcoin is divisible up to 8 decimal points. So it's this extreme divisibility that makes Bitcoin scarcity possible. And utility, so which is one of the biggest selling points of Bitcoin, which is the use of its blockchain technology, which is decentralized and also trustless. And then transportability. So Bitcoin is transferable between parties within minutes, regardless of the size of the transaction, and with a very low cost. And then also durability. So a dollar bill, while it's sturdy, it can be torn or burned or like otherwise rendered unusable. However, digital forms of payment are not susceptible to these physical harms in the same way. And lastly, counterfeitability. So Bitcoin is incredibly difficult to counterfeit. The only way to create a counterfeit Bitcoin would be by executing a double spend. So it's very unlikely, given the size of the Bitcoin network, as a group of miners would need to control more than half of all the network power to dominate the remainder of the network to falsify records. So such an attack on Bitcoin requires an overwhelming amount of effort, money, and computing power, thereby rendering the possibility extremely unlikely. So here's a simple comparison of Bitcoin against fiat currencies regarding these 6 attributes, so you can have a look. Okay, and then next we have mining. I'm sure you've heard of the term Bitcoin mining before. So mining is the process that maintains the Bitcoin network, and it's also how new coins are created. So all transactions are publicly broadcasted onto the network, and miners bundle large collections of transactions together into blocks by completing a cryptographic calculation that's extremely hard to generate but very easy to verify. So the first miner to solve the next block broadcasts it to the network, and if proven correct, is added to the blockchain. And then the miner is rewarded with some Bitcoin. So mining is actually a painstaking, costly, and only occasionally rewarding process. So to earn Bitcoins, you have to meet these 2 conditions. So firstly is to verify 1 megabyte worth of transactions, which is the very easy part. And then also to be the first miner to arrive at the right answer or the closest answer to a numeric problem. So this process is known as proof of work, which is the consensus mechanism of Bitcoin. So more on proof of work, this algorithm is used to confirm transactions and produce new blocks to the chain. With proof of work, miners compete against each other to complete transactions on the network and get rewarded. So miners have to solve complicated mathematical puzzles that can be easily proved. These math puzzles are issues that require a lot of computational power to solve. So it could be a hash function, or how to find the input knowing the output, or an integer factorization, which means how to present a number as a multiplication of 2 other numbers, or a guided tour puzzle protocol. So if the server suspects a denial of service attack, it requires a calculation of hash functions for some nodes in a defined order. So the answer to a proof of work problem is called a hash. It's a fixed length alphanumeric code that is used to represent words, messages, and data of any length. So as the network grows, it faces more difficulties. The algorithm needs to generate greater hash power to solve. So the complexity of the task is a very sensitive issue. So the problem can't be too complicated. If it is, the block generation takes a lot of time and the transactions are stuck without execution and the workflow just hangs. But if the problem is too easy, it's very prone to vulnerabilities like denial of service attacks and spam. So, and then this solution also needs to be easily checked. Otherwise, not all nodes can analyze if the calculations are correct. So the algorithm is implemented when miners solve the puzzle, form the new block, and confirm the transactions. How complex a puzzle is depends on the number of users, the current power, and the network load. The hash of each block contains the hash of the previous block, which increases security and prevent any block violation. So if a miner manages to solve the puzzle, the new block is formed, and then the transactions are placed into the block and it's considered confirmed. So let's have an example of how the hash problem works. So if I tell Gary, Ezra, and Joshua that I'm thinking of a number between 1 and 100, and I write that number on a piece of paper and then seal it in an envelope. They don't have to guess the exact number, but they just have to be the first person to guess any number that is less than or equal to the number I'm thinking of. And there is no limit to how many guesses they get. So let's say I thought of 19. So if Gary guesses 21, he loses because 21 is greater than 19. And then if Ezra guesses 16 and Joshua guesses 12, then they've both theoretically arrived at viable answers because both 16 and 12 is smaller than 19. But there's no extra credit for Ezra, even though Ezra's answer was closer to 19. So now imagine that I pose the guess what number I'm thinking of question, but I'm not just asking 3 friends. And I'm not just thinking of a number between 1 and 100. Rather, I'm asking millions of would-be miners that I'm thinking of a 64-digit hexadecimal number. And now you can see that it's going to be very hard to guess the right answer. So if both Ezra and Joshua guess the answer simultaneously, and then the analogy breaks down. So in Bitcoin terms, simultaneous answers occur frequently, but at the end of the day, there can only be one winner. So when multiple simultaneous answers are presented that are equal to or less than the target number, the Bitcoin network will decide by a simple majority, which is 51%, which miner to honor. So typically, it's the miner who has done the most work, or in other words, the one who has verified the most transactions. So the losing block will then become an orphan block. So these orphan blocks will not be added to the blockchain. So here is an example of such a number, the 64-digit hexadecimal number, and it can consist of numbers and also alphabets. So remember that analogy where I wrote down the number 19 on a piece of paper and then sealed it in an envelope? Well, in Bitcoin mining terms, the metaphorical undisclosed number in the envelope is called the target hash. So what miners are doing is guessing at this target hash, and then miners make these guesses by randomly generating as many nonces as possible, as you can see in this rectangle. So they try to do it as fast as possible as well. And a nonce is actually short for number only used once, and the nonce is the key to generating these 64-bit hexadecimal numbers. So the first miner whose nonce generates a hash that is less than or equal to the target hash is awarded credit for completing that block. So why use the proof of work consensus algorithm? Well, it provides defense against denial of service attacks. Proof of work imposes some limits on actions in the network, and they need a lot of effort to be executed. So efficient attacks requires a lot of computational power and a lot of time to do the calculations. Therefore, these attacks are possible but useless since the costs are too high. And then secondly, also mining possibilities. It doesn't matter how much money you have in your wallet. What matters is to have a large computational power to solve the puzzles and form new blocks. Thus, the holders of huge amounts of money are not in charge of making decisions for the entire network. And then let's look at some flaws in the proof of work consensus algorithm. So firstly, huge expenditures. Mining requires highly specialized computer hardware to run the complicated algorithms where the costs are unmanageable. And this large cost can threaten the centralization of the system. And then secondly, uselessness of computations. So miners do a lot of work to generate blocks and consume a lot of power. However, their calculations are not applicable anywhere else. And lastly, it can be attacked by a 51% attack or a majority attack. So this is a case when a user or a group of users control the majority of mining power, and the attackers get enough power to control most events in the network. So this will be covered in a greater detail in next week's lesson. So back to Bitcoin mining, the number of Bitcoins rewarded will halve around every 4 years. And here we can see how the reward has halved over time. So this happens because in the Bitcoin software, there has been a hard limit set, which is 21 million coins. So the total number of coins will be in circulation by around year 2140. And roughly every 4 years, the software makes it twice as hard to mine Bitcoin by reducing the size of the rewards. So when Bitcoin was just launched, it was almost possible to instantaneously mine a coin with even using a basic computer. And now it requires rooms full of powerful equipment, which when combined with a volatile Bitcoin price, can sometimes make mining more expensive than it is worth. And miners also choose which transactions to bundle in a block, so fees of a varying amount are added by the sender as an incentive. So once all the Bitcoins have been mined, these fees will continue as an incentive for mining to continue. And this is needed as it provides the infrastructure of the Bitcoin network. So the mining difficulty of a cryptocurrency like Bitcoin indicates how difficult and time-consuming it is to find the right hash for each block. As a cryptocurrency like Bitcoin becomes more popular, the number of computers participating in its peer-to-peer network increases. So miners compete against each other for limited block rewards. With more participants and more computing power, the hash power of the entire network increases accordingly. So mining difficulty in the Bitcoin network is adjusted automatically after 2016 blocks have been mined in a network, and adjustment of difficulty upwards or downwards depends on the number of participants in the mining network and their combined hash power. So solving the mathematical puzzles for valid block creation requires huge amounts of computational power. And because the difficulty is rising continually, miners join forces in Bitcoin mining pools and solve the mathematical puzzles together. The first individual miner or the mining pool that finds the right hash gets the block reward. And usually, block rewards consist of new coins or tokens native to the blockchain network like Bitcoins. So in a mining pool, the block rewards are split among participants in proportion to their share of computing power in the mining pool. So this way, each participant is adequately invested in the process. So you would have heard me mentioning about the term hash multiple times previously. So let me explain on that. So the hash rate is actually an important metric for assessing the security of a blockchain network. The more machines dedicated by honest miners to discovering the next block, the higher the hash rate rises, and the harder it becomes for malicious agents to disrupt the network. So a 51% attack, for example, is when a single individual or group of attackers purchases or rents enough mining equipment to control over 50% of a blockchain's hash rate. So because blockchains are trustless and abide by a rule known as the longest chain rule, a person or group that controls a majority of the hash rate could, in theory, block or reorganize transactions or even reverse their own payments. So this would create double spend issues, which in turn would completely undermine the integrity of the underlying blockchain. So a fall in hash rate will mean a reduction in the cost to perform a 51% attack, making the network more vulnerable. So as you can see from this diagram, we can see that Bitcoin's hash rate has actually gone up over time, and this means that the mining difficulty has gone up. So as more and more miners have entered, the hash rate has been pushed up, and the most likely reason for new miners joining is because Bitcoin's extreme price potential. So increase in demand for Bitcoin has pushed the price really high, attracting more operators who see mining as an opportunity to make significant returns. And any increase in the number of miners would then push Bitcoin's difficulty up, which then drives the hash rate up. So now you might be wondering, how can I get my hands on some Bitcoin? So there are a few ways to get Bitcoin. So from cryptocurrency exchanges, investment brokerages, Bitcoin ATMs, and also peer-to-peer purchases. So where can you store your Bitcoins after buying some of them? Well, there are two kinds of digital wallets, hot and cold wallets. So for a hot wallet, Your digital currency is stored in the cloud on a trusted exchange or provider, and it's accessed through a computer browser, desktop, or smartphone app. And then for the cold wallet, it's an encrypted portable device, much like a thumb drive, that allows you to download and carry your Bitcoins. So these are some examples of hot and cold wallets and how you can imagine them to function. So basically, a hot wallet is connected to the internet and a cold wallet is not. So this will make hot wallets more vulnerable to hacking. So a Bitcoin wallet contains a public key and a private key, which works together to allow the owner to initiate and digitally sign transactions, providing proof of authorization. You can see the public key like a username and then a private key like a password. A hash of the public key is called an address, and it's the one displayed on the blockchain. So to receive Bitcoin, it's enough for the sender to know your address, and the public key is derived from the private key, which you need to send the Bitcoin to another address. So this system just makes it really easy to receive money, but requires verification of identity to send it. So here is how the Bitcoin address would look like over here. So one problem to consider would be that since Bitcoin operates without any central authority, if you make any error with your transactions on your wallet, like sending Bitcoins to the wrong person or forgetting a password, there's no one to save you. Okay, so let's take a deeper look at exchanges. So before we begin discussing the topic of centralized versus decentralized crypto exchanges, we should first understand what a crypto exchange is. So they refer to places where you can buy or sell crypto, and every crypto exchange has its unique rules and regulations, but they all provide you access to cryptocurrencies. So there are mainly two kinds of exchanges, centralized and decentralized. So a centralized cryptocurrency exchange is a platform where you can buy or sell digital assets. So here you have to trust a third party to monitor the transaction and secure the assets on your behalf of the buyer and the seller. So their deals aren't tracked on the blockchain, and such exchanges require you to submit your personal information for verification. And on the other hand, if you're a company, then you'd have to provide your corporate information to the exchange so that it can verify your account. So the more details you provide to these exchanges, the higher your withdrawal quota will be. So verified users on this platform can contact the support team of the exchange in case of any technical errors, like if they lose their password. And also in most cases, centralized crypto exchanges provide their users with flat pairs at stable prices. So these exchanges are widely popular among crypto users, and you can easily find one of these platforms online. So some examples include Binance, Coinbase, Local Bitcoins, and others. And next we have the decentralized crypto exchanges. So it's very similar to a centralized one, just that it doesn't have a third party that you can rely on. And then all of the funds in this exchange remain stored in the blockchain. So these platforms allow peer-to-peer trading. So here is a more detailed look at the differences between the both exchanges. So firstly, control. In a centralized crypto exchange, most of the control over your account remains in the hands of the third party which runs the exchange. And on the other hand, with the decentralized exchange, all of the control of the account remains with you. And security. So decentralized exchanges offer more protection than centralized exchanges. So a considerable risk of trading with centralized crypto exchanges is of hackers. So they can hack third parties which use private keys to access all of the funds of the users, and you could lose all of your deposit. Next, popularity. So currently, centralized crypto exchanges are more popular because they entered the market first. And even though decentralized exchanges have peculiar advantage over their centralized counterparts in wallets and accounts, they are far behind in popularity. So that's also because centralized exchanges offer better infrastructure and liquidity. Next, we have fees. So centralized platforms impose charges on their users for their services, and these fees vary from provider to provider according to the features one provides. So decentralized exchanges have either zero charges or very minimal charges for matching orders on the blockchain. And next, features. So centralized crypto exchanges have the edge over decentralized one, where you can perform margin trading, use portfolio management tools, and also use multiple advanced order types to trade better. And next, for regulations, it's easier to regulate centralized exchanges than decentralized ones. So centralized platforms require licenses and also must adhere to the rules of the local regulatory authority of their region. And liquidity, so centralized crypto exchanges have more liquidity because multiple users make particular orders according to market trends. So if an asset is in demand, various users will purchase or sell it accordingly. Moreover, it has market makers who add further liquidity to the platform. And lastly, we have speed. So decentralized platforms are actually slower. So according to analysis, centralized crypto exchanges takes an average of 10 milliseconds to execute orders, where a decentralized exchange takes a minimum of 15 seconds to match and fill an order. So are you thinking of using Bitcoin? Here are some pros and cons for you to consider. So firstly, a pro would be user autonomy. So users can control how to spend their money without dealing with a third-party authority like a bank or a government. And then discretion. So Bitcoin purchases are very discreet, where purchases are not really associated with your personal identity, just like using cash to buy things, and it can't be easily traced back to you. But this is not to say that Bitcoin transactions are truly anonymous or entirely untraceable. It's just much less readily linked to your personal identity. And then the peer-to-peer focus. So in a Bitcoin payment system, you can send or receive payments to and from anyone on the network around the world without requiring approval from any external source or authority. And next, elimination of banking fees. So there are no fees related to account maintenance or minimum balance fees or overdraft charges or like any of these fees you'll find with a bank account. And then mobile payments. So just like any online payment system, Bitcoin users can pay for their coins anywhere with internet access. So this means that purchasers will never have to travel to a bank or a store to buy a product. And lastly, we have accessibility. Because users can send and receive Bitcoin with just a smartphone or computer, Bitcoin is theoretically available to a population of users without access to traditional banking systems, credit cards, or other modes of payment. And then on the other hand, we have some cons. So firstly, price volatility. There can be huge spikes in Bitcoin's prices, which is driven by speculators rushing into the market. So in 2017, there was an unprecedented boom, but then the price of Bitcoin fell by about 65% in 2018. And there are also hacking concerns. So while backers say that the blockchain technology behind Bitcoin is even more secure than traditional electronic money transfers, Bitcoin hot wallets have been an attractive target for hackers. So there have been a number of high-profile hacks where more than $40 million worth of Bitcoin was stolen from several high-net-worth accounts. And next, limited use. So currently not many companies are accepting Bitcoin payments. And lastly, it's not protected by the SIPC, which stands for Securities Investor Protection Corporation. Basically, they insure investors up to $500,000 if a brokerage fails or if funds are stolen. But then this insurance doesn't cover cryptocurrency. Okay, so for this video, you should have understood the following. So Bitcoin is a digital cryptocurrency which operates free of any central control or the oversight of banks or governments. And instead, it relies on a peer-to-peer software and cryptography, and it uses a proof-of-work consensus mechanism. And the public ledger records all Bitcoin transactions, and copies are held on servers around the world. Anyone with a spare computer can set up one of these servers, known as a node, and consensus on who owns which coins are reached cryptographically across these nodes rather than relying on the central source like trust of a bank. And then every transaction is publicly broadcasted to the network and shared from node to node. And every 10 minutes or so, these transactions are collected by miners into a group called a block, and then it's permanently added to the blockchain. And Bitcoins are so valuable because they have the 6 key attributes of successful currencies. And Bitcoin mining is a complex and occasionally rewarding process where you must be the first miner to arrive at the right or closest answer to a numeric problem to be rewarded with some Bitcoin. And this reward would halve around every 4 years. And there are many ways for you to buy Bitcoin. And in the same way that you would keep traditional coins on a physical wallet, virtual currencies are held in digital wallets and can be accessed from client softwares or a range of online and hardware tools. So thank you for watching video 1, and I'll see you in the next video. Bye!